Good afternoon, Scott Redler, T3 Live. Welcome to today's recap. So we start off the day with a lot of weakness. I think the futures are down 5-6 handles. At some point, though, in the afternoon, Dow went positive, S&P almost went positive, but there were definitely some stocks got beat up more than others, and there were some stocks that you just couldn't get out of. There was a small chance to salvage some of the trade in a few of the stocks that we were caught in overnight, and there were some that you just had to get out of the way. As far as the chart of the S&P, though, if you take a look, really, no real damage here. We've talked about this cup and handle type pattern where, it's been riding the 8 and 21 day all the way up. This was the breakout when the ECB came out with their news. This was QE, and every bear is claiming victory. And look where we are. We're flagging up here, still holding the 8-day moving average. Pretty unbelievable. So all in all, it definitely is choppier than it's been. I tried to talk about the last time we had an outside day right here. It led to about 11 days of choppy mess before going again. And then this time there was 4 days. And now after this, remember that Friday, September 14th, after QE, when the oscillator hit plus 60, it's been 1, 2, 3, 4, 5, 6, almost 7 days of choppiness, 7 days of selling strength, buying weakness, which is not an easy thing for momentum traders to do, which I know. But at this point, still going sideways, 21 days playing some catch up. All in all, lot to like. And then today, it was definitely one of those days where you had to be in a lot of the right things. Just to really just talk about Google real quickly, congratulations to macro investors who stayed the course. First quarter or two was definitely choppy. You probably might have even got stopped out when it broke the 200-day, but then you had multiple chances to get back in after this quarter's earnings, if that's the way you maneuver. Once it traded above 620, 645, the highs of the year, lo and behold, stocks at historic highs. Talked about it so many times. Hopefully, you took advantage of it. If you look at the chart here, unbelievable move. This is when it started acting better. Right here after earnings, right when it broke this mini downtrend. We talked about 620s being viable, 645, and then once it took out, the highs of the year. And since then, what a run it's had. There was even a really good strategy. I know Sperling took the pain and helped us all through it when it came in to retest a 21-day right here at 681. Talked about it being a good active trade right there, or maybe even a swing trade if you put a stop in at the low of the day. If you treated it as a swing trade, you never had any pain. You could have held it, because even right here, when it hovered at near the highs, look what it did here. It held the top third of this overall range and gave you a nice momentum move through these highs for then a stretch to historic highs. And you go to the monthly chart now, and it's right there. Congratulations. This is, was the high beta pick of the year. If you stayed with it, great. If you didn't stay with it and you just got back involved as it started to trade better, there you go. On the flip side, today we got a little blindsided by Apple. Even though we weren't in tier 2 or tier 3, even tier 1 hurt when you're down, almost 2% off the open. But what happened was, if you had some levels in front of you, you could have traded out of it pretty decently. Talked about 683 to 685 as a level of support, on the radio around 9 o'clock and change, maybe even in the morning call. I don't remember exactly. Then we talked about the 21-day moving average, which was about 679. So lo and behold, you look at Apple right here, down day, not the end of the world, okay? Broke the 8-day off the lows, though, so at least you had a way to trade around your position. You go to the 3-minute chart, right off the open. You take a look here. This was a nice active trade. If you didn't take stock overnight, I know a lot of guys on the desk saw the opportunity, made money. This low was put in real quick, okay, and it was targeted around 683 to 685. Once it cleared this area, you had a nice little move all the way up to almost 694. Okay, so that's a nice active little strategy there. And then once it broke this upper level, you get out of the way. And then some guys actually even made money short. Once it broke 688.50, I just got out of my active but stayed in my swing. And then end of the day, you had another nice move towards the highs. And lo and behold, here you are on the daily. Trees being shaken up a little bit. Come into the 21-day, still very healthy. I'd say the longer it stays above this 21-day, I think that the better it is for it to take out 705 quicker. I guess you could see a quick move to the the 50-day at some point if they don't clear up some of these supply chain issues or whatnot. I personally think that doesn't happen, but who am I to say that? So right now you have a point of reference right here at 683. I'm long small still, not as much as I had here, not as much as I had here, but a little bit. And then if we would have taken out 683, I probably would have got flat, because chances are I do think we do test this 21-day, which we might not, or maybe even test this gap right around here. So all in all, not so bad. If you remember, Google looked really bad right around there. Right after this 2-day down move on the 3rd day, when they really capitulated people out, I think I tweeted them like, at 682, I'm a buyer, or 681. If it goes down to 680, to here, I'm not a seller, I'm buying more. And I wound up holding, then lo and behold, pow, and then a lot of different things to do along there. As far as Facebook's given us some opportunities from the lows at 1850, 1940, 2205, and then it was acting pretty well before Barron smacked it on the front cover saying $15. So with that being said, there's nothing you could do about it except for salvage the trade. We talked about how it could come back up and retest maybe 21.95. If that, so if you felt uncomfortable, sell some there, and then that 21.27 pivot was where I got out of. If you look here at this point, it's not say it's broken, but it's not as compelling as it was as we were riding it. We talked about this gap up being an area to buy, and then another area right here when it crossed 1940, and then recently when it broke above this area. So it did look like it was flagging and ready to go again, but you never want to have as much here as you had here, or even here. And now at this point, it did hold this gap. Okay, so I would say it is okay. Not okay, just in general. It's not like it's going to see 15. It has to see 15 because Barron said so. Barron also said a lot of different calls where it's been a contrarian indicator. But anyway, today it kind of hurt. It closed at 20.79. The way I traded it, just to show you how you could trade out of it, in the first few minutes, I did try and buy a little bit into the support. Sold a little bit here, and then once it took out this low of the morning, this is where I just got flat. I just like, you know what, I'm done here. That was right around, the low here was 21.31. Actually, I think I got out here. So, it looked good for a second, but then I was like, you know what, I'm fine that I got stopped out. And then this really would have been your stop out, and then, really drove people nuts by continuing lower before reversing. So, tried to reflex up, couldn't do it. High, lower high, broke support, and nothing you could really do about it. It depends on how you played it. And then it rallied back up and then closed here. Go back to the daily. This is it. This is now your new point of reference. Let's see how it moves forward here. Does it try and come up and refill this gap, or does it stay within here and head lower? So, we'll evaluate as it goes. Something that I thought was pretty important, though, today was, if you remember, on September 14th, if you come back to me, Parker, on September 14th, the banks gave us clues that we could be overbought. We could put on some hedges. We could maybe even short some of the banks for a cutesy trade. And that was back here on the XLF. That was right around this day after a pretty massive move. This was being your add-on buy for momentum. Here's your little bit of a topping tail there. Here's your add as it broke through that low. And then today, coming into the 21-day, it did go green first. So, I did tactically try and enter a little bit of XLF there. If you look at Goldman, you have a little bit of a bottoming tail. So I know I traded it for a cute short in here, so I was looking to tactically get long. It's still above the 21-day. We can go sideways a little bit here. JP Morgan's actually acting best. Look at that. It didn't really pull in much. Nice flag here. So who knows? Maybe JP Morgan wants to grab the baton and be the better acting bank moving forward here. So we'll play that way. But overall, banks still hanging around. You go to the SPX, still hanging around. But then across the board, you have some mixed action. So at this point, I would say it's a little hard because we're about 20 handles off the highs. We're now about 15 handles above the 21-day. We're playing catch up. Stock selection has really been key. Managing your position size has been helpful. Unfortunately, we've had to, when things look good in the last week or a week and a half, you sell them. When things look bad, you buy them. And that's what happens when you digest and you chop around. Unfortunately, that's the type of market we're in now. It started last week. We started talking about how most bears finally started buying stocks, so it could make it tricky, and it has been tricky. We'll see how long this lasts, and then we'll keep measuring the composure. As of today, I think Sperling took off some risk. I just reshuffled a few things because I want to kind of be de-stressed. I don't want to give back anything that we've made over the course of this year, or even more recently between August and today. And as the market proves it could hold higher and we see some different patterns, we'll continue to trade with them. No need to be a hero here, but no reason to slam the door. I do think that the highs of the year of the S&P are not in. I do also think the highs of Apple are not in. But, I don't have to make those gun-to-head calls. All I want to say is, the trend has been up. Let's follow it. Let's just, stick with the trade, maneuver around, rotate around, and things will come to us once again. And if you get caught in some things that you can't help, just make sure you trade based on your risk tolerance and you keep moving forward. Scott Redler, T3 Live, the recap. See you at the morning call tomorrow. Have a good night. Hi, I'm Scott Redler, Chief Strategic Officer for T3 Live, and I would like to invite you to join us on October 6th and 7th in New York City for our first annual T3 Live Active Trader Super Conference. The two-day event will focus on what we believe to be the 5 keys to being a successful trader. We will teach you the strategies, tactics, and mindset we take to the market every single day, and you will leave the Super Conference with a personal step-by-step success blueprint. Visit T3Live.com and click on the education tab on the top of the page and watch preview videos of this event. Seats will fill up quickly, so be sure to reserve yours today. My colleagues and I look forward to meeting you. Have a great day.